I want to start with a number that almost nobody in the Western financial press is connecting to the gold market right now. The number is 1.1 trillion. That is how many dollars worth of United States Treasury bonds Japan currently holds on its central bank balance sheet. It is the largest single foreign holding of American government debt on earth, larger than China, larger than the United Kingdom, larger than every sovereign wealth fund in the Gulf combined. And right now, in May of 2026, that $1.1 trillion position is under the most acute stress it has faced in 40 years. Not because Japan decided to sell, because Japan may have no choice. I have spent 40 years watching the relationship between the Japanese yen, the United States dollar, and the gold market. And what I am about to show you is not a theory about what might happen. It is a mechanical sequence that is already operating, that has one historical precedent, and that every time it has played out in the last half century has produced the same outcome for gold. The investors who understand this sequence right now are not watching the daily yen-dollar exchange rate. They are watching something underneath it that moves much more slowly and hits much harder when it arrives. Subscribe now. Here is what is actually happening in Japan and why it matters to every person who owns gold, silver, or any dollar-denominated asset. The Bank of Japan held its key policy rate steady this week. It raised its inflation outlook from 1.9% to 2.8%, and it cut its economic growth forecast for 2026 in half to 0.5%. Read those three numbers together and you will see the same impossible arithmetic I see: rising inflation, collapsing growth. A central bank that cannot raise rates aggressively because its government is the most indebted developed nation on earth relative to the size of its economy, with a debt-to-GDP ratio above 250%. Japan is in stagflation, and Japan holds $1.1 trillion in United States Treasury bonds. That combination is the canary in the coal mine that almost nobody is watching clearly enough. Let me explain the mechanism step by step, because until you understand it, the connection to gold is not obvious. And once you understand it, you cannot look at the yen-dollar exchange rate the same way again. Japan imports more than 90% of its crude oil. Before the Iran war began on February 28th, Brent crude was $75 per barrel. After the Strait of Hormuz closure, it surged above $100. For Japan, that price increase is not an abstraction. It is a structural shock to the current account. Every barrel of oil Japan buys now costs 30 to 40% more than it did 10 weeks ago, and Japan buys a lot of oil. That surge in import costs creates immediate downward pressure on the yen. The mechanism is direct. Japan needs to sell yen and buy dollars to pay for dollar-priced oil. More yen sold means more yen in circulation, means the yen weakens against the dollar. The yen fell to a one-year low of 160.72 against the dollar before Japanese authorities intervened this week. 11 new record lows in 16 trading days. That is not volatility. That is a structural deterioration in the currency of the nation that holds more American government debt than any other country on earth. Now, here is where the mechanism becomes dangerous for the broader global monetary system. When the yen weakens, Japan faces a choice that has no clean answer. Option one, let the yen fall. That makes Japanese exports cheaper and more competitive globally, which helps manufacturers, but it also makes every import more expensive, which worsens the inflation that is already running at 2.8% and erodes the purchasing power of Japanese households who are already among the most financially conservative savers in the developed world. A collapsing yen is political poison in Japan. Option two, raise interest rates to defend the yen. Higher rates attract foreign capital back into yen-denominated assets, which supports the currency. But Japan's government debt is 250% of GDP. Every 25 basis point rate increase adds tens of billions of dollars to Japan's annual debt service cost. The Bank of Japan already owns more than half of all outstanding Japanese government bonds. If it raises rates, it is raising the cost of its own balance sheet simultaneously. The arithmetic of sustained rate hikes against a 250% debt to GDP ratio is not survivable without a fiscal restructuring that would take years and create its own crisis. Option three, sell foreign reserves, specifically United States Treasury bonds, to raise dollars and use those dollars to buy yen in the open market. This is what Japan has done before. It is what Japan's Ministry of Finance has signaled it is prepared to do again. And this is the option that connects Japan's currency crisis directly to the gold market in ways that most investors are not yet pricing. To understand why Japan selling treasuries matters for gold, you need to understand what happens in the US Treasury market when the largest foreign holder begins reducing its position. Japan does not need to sell all $1.1 trillion to move markets. It does not need to sell half. When a sovereign holder of this size begins selling even a fraction of its treasury position, it adds supply to a market that is already digesting the largest domestic issuance in American history. The United States is refinancing $9.2 trillion in federal debt this fiscal year. At current rates of 3.5 to 3.75%, the annual interest cost on that debt is already $1.03 trillion, more than the entire defense budget. Every additional seller in the Treasury market at this moment, whether it is Japan defending its currency, Turkey covering its oil import bill, or Russia liquidating ahead of its export ban deadline, adds pressure to a bond market that is simultaneously being asked to absorb the largest domestic borrowing program in American peacetime history. When Treasury supply increases faster than demand, yields rise. When yields rise, the dollar typically strengthens. And when the dollar strengthens while yields are elevated, gold faces the same mechanical headwind it always faces in this configuration. But here is what is different about the Japan scenario from every other source of Treasury selling pressure currently operating. Japan is not selling because of a crisis it caused. It is not selling because it is sanctioned. It is not selling because it lost a war or because its currency was mismanaged by ideological choices. Japan is selling or preparing to sell because the United States allowed oil prices to reach $100 per barrel, which is pressuring the yen, which is forcing Japan's hand on a treasury position it accumulated over decades as a direct consequence of the dollar's reserve currency status. The world's largest foreign holder of American debt is being pushed toward liquidation by the downstream consequences of American foreign policy in the Middle East. That is not a commentary on the rightness or wrongness of that policy. It is a description of the mechanical chain that connects the Strait of Hormuz to the yen, to the treasury market, to the gold price. And that chain is operating right now. Now, let me give you the historical context because I have watched one version of this sequence before, and the outcome for gold was unambiguous. In 1985, the G5 nations signed the Plaza Accord at the Plaza Hotel in New York. The agreement was designed to deliberately weaken the United States dollar against the Japanese yen and the German mark. The dollar had strengthened dramatically in the early 1980s as Paul Volcker's rate hikes attracted capital from around the world. American manufacturers could not compete. The trade deficit had exploded, and the political pressure to weaken the dollar became overwhelming. The Plaza Accord worked. The dollar fell approximately 50% against the yen over the following 2 years. Japanese exports became more expensive in dollar terms. American manufacturers got relief. And gold, which had been suppressed by the strong dollar environment of the early 1980s, began the next leg of its structural bull market as the dollar weakened, and real yields came down in response to the coordinated policy shift. The 2026 version of this dynamic is structurally more extreme in every measurable dimension. The dollar is not being deliberately weakened by a coordinated G5 agreement. It is being structurally undermined by the fiscal arithmetic of a nation carrying $39 trillion in debt, paying $1.03 trillion annually in interest, running a $40 billion per month Treasury purchase program under a name that is not quantitative easing, while simultaneously managing the geopolitical consequences of a Middle East war that is pushing oil above $100 per barrel and pressuring every oil importing nation in the world to sell their dollar-denominated reserves to cover their energy bills. The direction of travel is the same as 1985. The magnitude of the underlying structural forces is without historical precedent. I want to address the intervention question directly because it is the piece of this story that is generating the most noise in financial media right now and the least analytical clarity. Japan intervened in the currency market this week. The yen surged 3% against the dollar on the day of the intervention. By the following morning, most of those gains had been paired. Every analyst who covers the yen for a living said the same thing in the hours after the intervention. Intervention will only get them so far. The factors that contribute to a weaker yen remain unchanged. That is the precise framing I want you to hold on to. Intervention changes the daily price. It does not change the structural forces. Japan cannot print oil. It cannot make the Strait of Hormuz reopen by buying yen in the currency market. It cannot reduce its debt-to-GDP ratio of 250% by spending its foreign reserves on currency defense. Intervention is a signal that the pressure has become politically intolerable. It is not a solution to the arithmetic that created the pressure. And every time Japan has intervened to defend the yen in the past decade, the intervention has bought weeks or months of stability before the structural forces resume their work. The structural force in 2026 is the same one it has always been. The cost of energy, priced in dollars, against a currency whose central bank cannot raise rates enough to attract the capital flows that would support it without destroying the fiscal arithmetic of the most indebted, developed government on earth. Here is what I am watching most closely to identify when the Japan Treasury gold chain produces its most significant market impact. The first indicator is the USD JPY exchange rate at the 160 level. When the yen breaks back toward 160 against the dollar despite intervention, it signals that the structural selling pressure on the yen has exhausted the intervention capacity of the Ministry of Finance, and that the next policy response will necessarily involve either a more aggressive rate move by the Bank of Japan, which would be structurally bullish for gold by reducing the demand for dollar-denominated assets as a yield alternative, or a more significant reduction in Japan's Treasury holdings, which adds supply to the bond market, pushes yields higher in the short term, and eventually forces the Federal Reserve into a policy response that is structurally bullish for gold. Both paths, the rate hike path and the Treasury selling path, lead to the same destination for gold. The timeline is different, the destination is not. The second indicator is the spread between the 10-year US Treasury yield and the 10-year Japanese government bond yield. When that spread narrows, it means either American yields are falling or Japanese yields are rising or both. Either direction of narrowing reduces the incentive for Japanese investors to hold dollar-denominated assets rather than their own government bonds. When Japanese capital repatriates from dollars into yen, it is structurally dollar negative and structurally yen positive. And when the dollar weakens against the structural backdrop I have described, gold prices in the mechanical headwind I described earlier dissipates. Watch the spread. It tells you when the capital flow reversal is beginning. The reason I use the phrase canary in the coal mine to describe what is happening in Japan right now is not rhetorical. In a coal mine, the canary does not cause the dangerous gas that kills miners. It simply detects it first before humans can. Japan's yen crisis is not the cause of the structural pressure on the dollar's reserve status. That pressure comes from $39 trillion in debt, from $1.03 trillion in annual interest payments, from $40 billion per month in Treasury purchases under a name that is not quantitative easing, from central banks that have bought gold at double the historical average for 3 consecutive years, from a petrodollar system under acute stress because the waterway that prices oil in dollars is commercially disrupted. Japan's yen is detecting all of that pressure in a single exchange rate, 160 yen to the dollar, a number that was politically unthinkable 2 years ago, a number that Japanese authorities intervened to prevent this week, a number that the structural forces say is not the ceiling but the floor if the underlying arithmetic does not change. And the underlying arithmetic cannot change without either a resolution of the Iran war that brings oil back towards $75, which remains uncertain, or a Federal Reserve pivot that reduces the yield differential attracting capital into dollar assets, which the current inflation environment prevents, or a fiscal restructuring of American government finances that reduces the debt service burden, creating the Treasury supply that is pressuring the entire global monetary system. None of those three resolutions is imminent, which means Japan's Canary is still singing. Yeah, the question is not whether the investors who are watching it correctly will benefit from what it is detecting. The question is how long the investors who are not watching it have before the signal becomes impossible to ignore. In 40 years of watching these markets, I have never seen a canary sing this clearly for this long before the rest of the market finally heard it. Most investors are not listening yet. Now you are.